Good afternoon to absolutely everybody. We really do appreciate your time. So starting on the first slide here, what we can see is the importance of doing what we want when we want. And that's a key kind of theory within financial planning. So when I look at financial planning and what we want to achieve in life, I look at three major things. First of all, that we spend time with our loved ones and the people that we like most around us. The second is that we have good mental and physical health. And the third is that we have options to do what we want when we want. And there are the three core themes that we want to get across today within our financial planning conversation. So moving on to the next slide, we're going to look into this in a bit more detail for us today. And we can look at in terms of what is financial planning itself. So financial planning essentially is having suitable vehicles to get to certain life goals that we have within our final destinations. This can range between short, medium, and long-term goals. So within short-term goals, these are typically things that take less than 1 year. So prime example of this would be what's known as an emergency fund. And this is something where if you've no money coming in for a couple of months and you just had money going out, you have a suitable vehicle or an account there where you can access those funds that are readily available to alleviate the financial stress of that event. And this could be a family passing, this could be losing a job. What we want to make sure is that if that was ever to happen to you, that you have an emergency fund there in place where the financial aspect is already taken care of and you just have to focus on the emotional aspect. Examples of this would be such as a current account, it would be a post office account, it would be a credit union, etc., etc. Moving on to more medium-term plans, this is essentially a vehicle that would be 5 years plus. Typically, these would take a few years to actually accumulate, such as, let's say, a deposit for a house, or let's say savings account for a kid's education fund. The key thing here, I suppose, is that the system is automated and it's planned, and that you have a suitable account whereby a monthly amount is going into those accounts. And the aim there to be essentially to beat inflation, which is the rising costs of goods and services. So what you're trying to do here is have an automated process where on a monthly basis, you have some money going in from your current account into one of these savings accounts that can then lead to, in 5 or 6 years' time, having enough of a deposit for the house and or for your kids or dependents' education. In terms of more long-term, we can see this is typically for something that is like 10 years plus, and typically this would be more retirement planning. So we look at something where we need to take action today for the future to give ourselves more options. The key thing here, I suppose, is to make our money grow and to put it into suitable kind of vehicles to help that to happen. And what we'd advise highly is for people within their own companies to look at these options as a starting point. So moving on to the next slide, we're going to kind of elaborate these points slightly more with some more specific examples. So in terms of establishing an emergency account, this is the very core basis of financial planning. Without doing this, it'd be kind of unwise to look at the other elements of financial planning. So the first thing we would ask everybody to do is to see, do they actually have an emergency account in place? As I said, it could be in a current account, it could be in a credit union, it could be on post. The key thing is that you have access to that money and that gives you a good grounding and a starting point. And the reason why I actually enjoy having an emergency account is that I can sleep well at night. You know, I know in the worst case scenario, if something was to happen to my family member or something that happened to myself, I have access to that cash and I know I can use that. So that's why it's very, very important. It's more for your comfort levels more than anything else. In terms of building your wealth, we look at people who maybe have a more medium-term plan. They may be saving on a monthly basis more now because of coronavirus. And as a result, what we try and do and see is, can we put that money to greater use over medium-term perspective? And there's various solutions that we'll discuss further on the slides in terms of savings plans, funds, etc., etc. Another very, very crucial point is life protection. So this is a case where if something was to happen to you, what would happen to your loved ones post that event happening? This could be a serious illness, this could be a death. In particular, people who have mortgages, who have car loans, who have credit card debt, and who also have dependents. This is a crucial aspect of financial planning, is to make sure in the worst case scenario that these people are looked after and that the financial strain at least is alleviated and eliminated. And that's what we try and do here. It's all about reducing your risk and make sure that we look after you. In terms of retirement planning, you may know recently that the government announced that the retirement age has increased to 68. So we look at what can happen and what can we do today to allow us to get to a stage where we don't actually work to the age of 68 unless we actually want to, you know, that we don't essentially have to do that. And what we try and do is outline solutions there, which we can do from a pensions point of view, either within your own companies or externally, that can help you with that planning aspect. And so moving on to the more detailed slides now, post this one. We can see a key rule within financial planning, which has been noted by a lot of academics in this industry, which is known as the 50-30-20 rule. And I suppose if we go to the next slide, I'm going to outline what this actually is with captions. So when I look at people's budgets in my role and also my own personal budget, I think we could all agree that rent or mortgage payments, including household bills and food, would be about half our net worth. on a monthly basis, which is essentially what's left in our pocket after tax, which is the most important amount. And then we probably have about, a third of it that would go to discretionary expenditure, like, having coffees, buying stuff online, and maybe gym memberships, Spotify, etc. And then we only have maybe between 10 and 20% for actual savings. So this could be in terms of pension, this could be an emergency fund, this could be more medium-term planning. And while these figures are kind of just general and broad, the key thing for us is to look into our budgeting and see where the actual money is going, and can we actually make it, can we essentially put it to better use. So moving on to the next slide here, we're going to outline how we can cut out unnecessary costs. So some things that we look in our daily lives, whether it be, eating outside, or these days, getting something delivered to our house, and also, having coffees and stuff like that, we can see that this is a tremendous cost on our daily budgets. And what I do for myself is I say, look, I'm a big coffee drinker, and I say to myself, can I still access that drink at a better quality, cheaper? So what I did myself during the pandemic is I bought myself a coffee machine. So spending €3 or €4 or €6 in Starbucks, I'm now spending 30 cents per capsule in my house, and using that excess money to put into my emergency account, to put it into my pension, to put it into my dependents' education account, whatever it might be. You might have similar plans and similar situations to myself. And that's all we're trying to do, is to show and outline where your money's going and how we can put it to better use, essentially. So I think this is a very, very powerful graph to cut out unnecessary costs. So moving on to the next slide here, we can see a topic that's called opportunity cost. So opportunity cost essentially is, if you have a choice between two options and you pick one, what would happen if you actually picked the other option? And what we see here is a car payment. And don't mind that the signs are in dollars. The same theory applies to any currency, such as the euro. And what we see here is, if you had a new car payment through a PCP, which is essentially whereby you go to a dealership, you put, let's say, €5,000 deposit, and then you pay €300 to €500 on a monthly basis, like you'd see in the ads. And then at the end, you make a big, large payment called the bullet payment. What we do here is we say to ourselves, right, the car might cost us €40,000. And you might say, right, I'm only paying about €400 to €500 a month. But realistically, the total cost is not that. The total cost is, if you actually didn't buy the car, or maybe you bought a second-hand car, or maybe didn't replace the car every few years, if you actually put that into a fund, which is a collective group of companies, and invested that, how much would you actually have in your pocket? Because we know cars depreciate, and we're probably shocked when we go to the car dealership and we say, right, I'm bringing you my car back. How much did you buy it off me for? And they're saying, right, we'll give you half or 40% of what it was worth just 3 or 4 years ago. It's madness. So what we try and do is we say, right, the car is going to depreciate. It's going to suck all this money and energy out of you. Why not buy a car maybe that's slightly cheaper, slightly less of a cost, and use that excess money to invest in your future and your family's future? So you're still getting the car, but you're also still getting a return on your money. And you see, over a 5 and 10 and 20 year period, if you were to invest in an average fund, which is a collection of different companies, and got 10%, your trade-off essentially is a few €100,000 over a 20-year period, which I feel is very, very powerful. So moving on to the next slide here, we can see the difference between what's known as being a consumer, which is buying products, which would be the AirPod Max, which I actually have myself. They're a very good product. And also buying Apple shares, which I hold myself as well. And what we're trying to say here is, whichever product or service you like, whether it be a Starbucks coffee, a Coca-Cola, Adidas, Nike here, all these companies have shares or stocks, which essentially whereby you can buy a portion of that online and actually have your financial well-being within that financial company's performance. So what I would say to people here is, for sure, buy the AirPod Max if you want, but don't replace it every single year. These companies have a tendency to release all these products and have these special ads and stuff like that. What we're trying to say to you is, buy it once and buy the stock the next time through a fund, and then let that pay itself off, because one will lose value. The other one, over a medium-term horizon, will more than likely actually make some money and appreciate in value. So that's just kind of a very powerful example of this. As I said, whichever product or service you like or brand you like, it will have an equivalent the same as this. Moving on to the next slide here, we can see this gentleman, who is Warren Buffett. He is actually one of the richest investors in the world. He is worth over $84 billion. So when he says something, I think we should take note of it. And you see this quote here, that 3 to 5 years of sacrifice, saving, focus, and investing can literally set you up for the rest of your life. And that's all we're trying to do here. We're trying to have a conversation with people, give them factors to consider. I think an important point to make is that we within Bank Farm are what's known as financial fiduciaries, which means that we don't actually work off bonus or commissions. Our sole aim here is to understand your needs, your desires, see who you are and where you want to get to, and see, do we have suitable vehicles to get to those final destinations, as I said, from your short, medium, and long-term planning. And I think this 3 to 5 year sacrifice is something that can be extended or shortened depending on how you'd like to do it. But don't see it necessarily as a sacrifice. See it as something that you're giving up a very, very small piece today for something better later on. I'm very sure that most of us don't want to be working today in our 60s or 70s. We work so hard for the money we gain today. why not put that to work and give ourselves options later on in life? You know, and it goes back to the first point in the slide, you know, having the choice to do what you want when you want. That's richness for me. That's wealth for me. It's not having a million in the bank. It's having the options later on in life. So moving on to the next slide here, we can see a word called inflation. So you may hear, you know, when you're in college or maybe when you're in secondary school on the media, you know, inflation is rising by 1 or 2%. So inflation is just the rising cost of goods and services, right? And I suppose the reason why it's important is that if the cost of something is rising and your salary is staying the same, it's obviously costing you more to buy it with less money. So the difference the thing we need to understand here is that all our favorite products and services, which I want to explain in the next graph here, on a daily basis are actually increasing in price. So your iPhone, your soft drinks, your chocolate bar, your Sunday newspaper, these usually are increasing year on year in terms of price. But what's very important is not the 0.6% that the CPI, which is the Consumer Price Index, which is what the Irish government measures, is. It's what's known as your lifestyle inflation, which is what your personal goods and services are increasing by. And over the next slide, we're going to kind of expel this a bit more. So, you know, when we think about health insurance, car insurance, the cost of the home, et cetera, these have increased more than 0.6%. I think people would agree. And the best example I give is my grandparents, you know, living in their current house that they bought me for 20 or 30,000 Irish punts back then. That's now worth a couple of 100,000. You know, that's what inflation is essentially. It's the rising cost of goods and services. And I think this graph is very, very powerful in terms of, you know, the cost of bread, which is you know, something that we need to eat pretty much on a daily basis alongside water, and how it's gone from 12 cents to 2.25 in the space of a couple of decades. Now you may say, Kevin, look, that's not too big of a difference. The importance here is how quickly it's doubled and the percentage difference between those two amounts. If you put a house there, if you put a pint of milk, if you put a newspaper, if you put your favorite chocolate bar, your favorite soft drink brand, it's the exact same. The importance here is how quickly it's actually doubled due to inflation. And as I said, the key thing with inflation is that we need to make sure that if we're keeping our money in the bank, we need to understand that they're printing it quicker than we can save it in terms of the governments. So what we need to see is there are alternatives there that we can put in place to make sure our money is actually worth more at the end of the day. So moving on to the next slide, we can see here that the US dollar has lost 50% of its value since 1991. So people might say, Kevin, why is that important? So the reason why it's important is that everything that you buy, from your components in your iPhone to your Ryanair flight for your summer holidays, that's all based on US dollar. So the US dollar has lost half its net worth over the past couple of years. The same thing has happened to the euro, the same thing has happened to everything that we're doing. So what we need to see is there alternatives there that we can put in place to reduce this risk? And as I said, with Bank of Ireland, all we're trying to do here is give you factors to consider, see your circumstances, and to reduce your risk at the end of the day. So moving on to the next slide here, we can see the impact of inflation on your spending power. So I'm sure, look, all of us would love to have $500,000 in the bank as per this example, right? Maybe some of us do, who knows? And then we should definitely speak. What we want to do essentially here is to illustrate, if you had 500,000 euros in the bank, and currently in the Irish economy, there's 200 billion sitting on deposit, where effectively people are paying to lose money due to the rising cost of goods and services. We can see over a 15-year period that depending if the prices of costs of services was between 2 and 5%, that they lose between 150 and 300,000 euros or dollars, which I think is a very, very bad deal. So I think it's important to see what alternatives are there. And what I always highlight people is if you had 100,000 euros in any Irish bank account, after DIRT, which is the deposit tax that you pay of 33%, you'd be left with 68 euros. Now that to me sounds like a very, very bad deal. And when I heard that a few years back, I said to myself, there's no way I'm participating in that. Once I have my emergency fund there and once I have my deposit for my house, I need to make sure that I have myself set up through my pensions and through my short and medium term planning within funds. So if we look on to the next slide here, we're going to illustrate these points a little bit more. So we look at a solution to this, which is what's known as compound interest. So what compound interest essentially is making money on top of money. So let's say if you had 100 euros, for instance, you made 10%, we've 110. The next 10% that you make is on top of that 110. And the reason why it's so important is that we talk about inflation eating and eroding your money over time. Compounding is through investments is a way of actually finding a solution towards this challenge, because that's all we're trying to do here. And over in the next slide now, we're going to explain this more with some visuals. So Albert Einstein, I'm sure people know him, one of the smartest guys in the world. I always take note when these smart people are talking and see what they're actually saying to us, which is a lot of learnings that can be taken. And he said, look, compound interest is the eighth wonder of the world. So why did he say that? In the next graph, we'll be able to explain this a lot better now. So we can see here that, you know, if you start with a very small amount, a penny, and it doubled every day for 30 years, after the 30th day, you can see the amount there is astronomical. So people always say to me, Kevin, you know, when do I start? Or, you know, only have 500 euros saved or 5,000 saved. I always say to them, it's better than zero. And that's not me being smart. That's a starting point. You know, at the end of the day, we need to understand our reality and where we are and where we want to get to. And if you only have 5,000 saved or 50,000 or 100,000, it doesn't matter. It's better than zero. And our aim is to get that as far away from zero as possible through effective financial planning. So what I always say to people is no amount is too small. And there is the best time to do these things is now. You know, I've been an investor for the last few years, and I feel a lot more comfortable that I'm going to achieve my life goal through financial planning, through my education, through talking to people who know more than myself. And what's going to give myself later on is options, through the systematic process that I've actually employed. So moving on to the next slide here, post the power of compounding, we see a real life example here between two people who started off their financial planning journey 6 years apart. And this goes back to the point in terms of the only two things you will regret with this, and that I do, is one, you didn't put in more, and two, you didn't put it quickly enough. And you can see here, if there's a 6 year gap between both people putting 500 a month, that is Alex and Jen, getting 10% return per year on index fund, which is again a basket of goods and companies out there, that there's a difference of about $500,000 between it. And our lesson here is that time is our greatest asset. And it really is the same thing with our health, the same thing with our wealth, the same thing with our relationships. If we keep on delaying these things and procrastinating, which is where the human mind is telling us, don't look into this because we're going to get stressed for a day or two, the stress that's going to be caused later on in your life will be multiplied by actually not taking action and having a conversation. And I do really believe that starting these points can only be done by having a conversation, by sending an email and saying, Kevin, you know, I'd like to discuss this. You know, I thought this was interesting. Can you explain this more? And that's all we're trying to do here. It's just get a conversation to see what your needs and your wishes and desires are and to help you achieve those. So moving on to the next slide here, we can see the thing called investing time and patience. So you may see in the media, you know, people are panicking about the stock market and saying, oh, this is going down, this is going up. Professionals in the game and in the industry know to ignore that. That's called financial entertainment. We're interested in financial education. We're interested in educating people and teaching them life skills that can be passed on to future generations in their family and can have a huge impact. So when we look at the market kind of going down by 10% over the last 38 years, and this is to do with the S&P 500, which is the top 500 companies in North America. So this would be Google, Amazon, Facebook, Pfizer, Coca-Cola, and Nike, Adidas. All the top kind of 500 companies are listed on the US stock exchange. And we can see that while the market may dip at certain points, and on the top graph in the red, you can see quite tragic. Over the longer term, you can see in the graph below, it's a very small blip. And we know as professionals, that's actually the best time to look into these options, because you're getting something cheaper. I'm sure if you went to online shopping later on tonight, or you went into a store and you had 30 euros in your pocket, and you said, I want to spend 30 euros on that t-shirt, and you found out it was discounted to 15, you're going to buy two, right? You're not just going to buy the one because you want that product, you're going to use it. This is the exact same thing. So people shouldn't be worried when these things go down. If you're invested in the best companies in the world and you have a plan and you've gone through the process, you will be absolutely fine over the long term. So thanks for showing that slide there, and we'll move on to the next one, if that's okay. So diversification, what is it? Diversification is essentially just looking at picking the best groups of companies within each industry. So what we try and do is we say to ourselves, right, what's important today? Technology, right? Amazon, Google, etc. We say that consumer products and services such as Coca-Cola and Starbucks and stuff are very important. We say that car manufacturers such as Tesla and NIO are important. So that's all diversification is. It's giving a broad basket of goods and services where if something is not working, that something else is always working. And that's what we're trying to do here. It's all about reducing risk. Gone are the days where you just pick one company and you'd hope for the best. Now you're picking the best companies in different industries and then hoping that through your participation with them over medium to long term, that you can replicate their growth and their story. And moving on to the next few slides, what we'll be able to do is to show you this with a few more visuals. So this is essentially an example of a fund, very, very powerful image. This would have been the S&P 500 fund that our rich investor, Warren Buffett, who I showed and mentioned, would have invested in. And it was an example where we showed people invested 500 a month or whatever they were suitable with, how over a period of time through compounding, they can have a very big amount of money. And you can see here, it is heavily dominated by tech, you know, Apple, Amazon, Alphabet, Microsoft, but you can see that there are 500 companies in total there. And while half is dominated by technology, the other half is dominated by all the other industries. So when people have a worry about technology companies, it's important to note that they're only 50%. There is a bigger story there. And you can see that some of the names are so small that you probably barely read them, but that is diversification. You know, it's getting a piece of the economy in every single industry. And it's making sure that, okay, if the pharmaceutical industry isn't doing well, technology is. If communication isn't doing well, engineering and construction is. And that's the beauty of it. And that's what we try and do as professionals with this for our people. Moving on to the next slide, we're going to discuss in a bit more detail. So people say to me, Kevin, why is technology performing so well? And I just say to them, look, you know, we've got to be logical about this and think how it actually impacts our daily lives. You know, we're looking at Google, It's our communication network in terms of, searching things online. We're looking at WhatsApp. We call our friends and family members through, we see them. We're looking at Zoom, like today, we do presentations on it. We look at, e-commerce websites, such as Amazon. We do orders from it. I did one last night. So each of these companies, because it impacts our daily lives, and it's going to impact them even more due to coronavirus, they are the best ones out there and have given the best performance, based in the last 10 years. And we're going to look in the next graph, it's going to outline this a bit more in terms of how much of an impact they've made for people's net worth and well-being. So here we can have what's known as Bank VAR and Target Saver, which goes back to the previous point in terms of what the bank can offer as a potential solution for people within these funds. So the key thing with this is to deal, I suppose, firstly with a financial fiduciary and whoever you're talking to. So a person whose interest is aligned to yours and can understand your life story, understand your needs, understand your ambitions, and can find appropriate solutions towards those and give you factors to consider. So the key thing with this is, people say, oh, Kevin, I only have, $300 a month. How am I going to invest in Google and Amazon? They're $2,000 to $3,000. 100% correct. What we do is we invest partially into these companies simultaneously. And that's why our barrier to entry in terms of how we can purchase these companies is only starting at €200 for a month through direct debit. In terms of flexibility, the key thing for us is that people are comfortable in what they're doing. So if they have increased expenses over time, they can pause payments, they can decrease payments, and that they have access to the funds as well, 10% per year, which is very, very good. And after the 5th year, they can access it fully. So the key thing there is when people start off on the journey, they'll discover what suits them best and what doesn't. And we allow them to have that flexibility, within these funds. And the most important thing is it's professionally managed. People say to me, Kevin, could I not do this myself? You could, yeah. I mean, if you've 2,000 to invest in Google and 3,000 to invest in Amazon and 1,000 to invest in Tesla, you could, but you're not going to be diversified. You're taking a lot of risk. It's not professionally managed. You're going to have to do all the tax returns yourself. So what we try and do is, and even myself, I have 2 target savers, and I'll explain which ones they are in the next slide. And what I've made sure to do is, he is a professional who's fully qualified. I even have my money professionally managed. And I think that tells everybody a lot. I do so many of these presentations, and I meet so many clients, from CEOs to managers to clerical staff to analysts. It doesn't matter the role. And I always say to them, if the professionals in the game are having their money managed professionally, what makes anybody think that they can do a better job? The whole concept of trying to beat the market and get a return better than what the best are doing in the game doesn't make sense. It makes a lot better sense to join them, to reduce your risk, to get a full understanding of what's happening, and for it to be professionally managed. I know Christina will send out my details and post these slides for anybody who wants to get more information on this and anything else we discussed from planning. And I'll be happy to speak to everybody on that. So moving on to the next slide, please. We can see the difference between savings and investments. So on the very first slide, we would kind of know in terms of having your emergency fund, we would know in terms, if you need a deposit for a house, having that in place, versus, once you have those 2 things within the financial planning journey completed, you can look more towards the investing side. And I think that's key to highlight. Our aim here is to make sure that whichever area you're in, whether it be short, medium, or long term, that you use suitable vehicles to get to those destinations, and that this is a systematic approach. We don't go to medium and long term until we have the short term done and ticked. And I suppose in the next few graphs, we're going to illustrate this a little bit better in terms of questions people need to ask, see what stage of journey they're at. So moving on to the next slide here. Yeah, so question that comes to me is, Kevin, should I save or invest? So depending on what life stage you're at, we can see some questions here and answers. And rather than saying yes or no, we're just going to say save or not save or to invest, essentially. So you can see here, you still don't have an emergency fund to cover 6 months of expenses. Save for that. That is your foundation. That is your basic starting point. That will give you comfort to sleep well at night. If you do not have that, it would be best practice to first have that sorted and then to have the investment conversation later on. So I'd say yes, save on that. And you have a purchase coming in the next 5 years that will require a large amount of cash, and save for that. Unless you've surplus cash on top of that, where you've already fulfilled your deposit requirements and where you have capacity to save or look into making a better return than deposits, it would make sense to save that money for your deposit, save the money for your emergency fund. And once you've completed those 2, then to have a conversation. So the advice there and guidance would be, again, to save and look after your best interest. The final one is your emergency fund is made that you have enough cash to pay for your big purchase, or you don't have a big purchase coming. Yes, some people say to me, Kevin, look, I'm not looking to buy a house now, or, I don't have anything coming up in the next 5 years. I have my emergency fund there. I don't have a lump sum, but I'm kind of saving 200 to 300 a month. I know it's kind of dead money in the bank. What's the option? The thing is to have a conversation, have a conversation. Let's get an understanding of, who you are, where you'd like to get to, and we can create a plan for yourself. And then post that, you know, best case scenario, you actually implement the plan to help yourself. Worst case scenario, you're just better informed, you know, which is still a very, very good win-win situation for everybody. So that's how I'd advise people in that situation as a qualified financial advisor and senior planner. So moving on to the next slide then, please. We can see the difference between deposits and investments. So I would highlight this point quite a few times in the conversation in terms of if you kept money in the bank versus if you were to invest this in the markets over a medium term of 5 years, what would happen? So here we can see that the starting point for both amounts is the exact same. The money that we're putting in is the exact same in terms of 500 euros. The time frame is the exact same of 5 years, but return is quite a bit different. So on deposit, if you were to put the 30,000 euros at the start, you're only making about 24 euros after 5 years. Now, as I mentioned before, I don't know who would find that acceptable. I mean, you're literally paying to lose money based on that due to inflation. While if you look at the S&P 500, which we would have described before, which is a big, large basket of goods and companies, we can see that the return there would result in about 13,000 euro difference between both points, which I think is very, very important. So it's just to give another factor to consider, something to kind of sleep on, a bit of food for thought. I know we are a good country of savings, but I do think that it is going to result in very, very difficult decisions having to be made on later on life as a result of us not actually participating in investing and actually opening our eyes to it. And moving into the next slides, I'm going to illustrate this point a bit further. So we look here in terms of all the Irish banks on average in terms of what they're giving us. So we mentioned here that we're getting about 0.04 or 0.03% on that, which isn't a very, very good price. And then at the bottom, we can see different options that we'd have. And so with other institutions in terms of if you were to invest in a fund, what would you get? And you can see here the technology fund, which invests in top 100 tech companies in the world, Google, Amazon, Facebook, Zoom Communications, et cetera, has done about 560% over the last 10 years. And you can see that, you know, over 1 year, 3 year, 5 year, and 10 year, it's done very, very well. And the North American S&P 500 tracker, which we mentioned as well, has done about 280%. You know, this again is compared to the 0.03% on average per year that the deposits do. We have the water fund, which is a very, very good performing fund as well. It's very important for people these days to invest in green and renewable energy. I have some investments in these myself. And then you have the alternative energy fund, which looks at kind of renewable energy companies, solar and wind, et cetera, et cetera. And even that has done about 160%. You know, and you're looking year to date, it's up 10% already, which is amazing, you know. So if you were to keep deposits for 10 years, based on what these guys have done just in 1 month, less than 1 month actually year to date so far, these have actually outperformed. And I think, you know, the ones I'm invested in personally are the technology and North American funds, and I have a little bit in the alternative energy one as well. And that's the beauty of what we can do as well. You don't have to be invested in just one. You know, you do have options there in terms of what you'd like to do and what suits you best. So moving on to the next slide, please. The importance of long-term planning. So I would have mentioned that, you know, our focus obviously today was on short, medium, and long-term planning. And all I'm trying to do essentially is to take action today between both parties to give us more factors to consider and options later on in life. And I suppose the next slide, when this comes up, please, I just want to illustrate kind of 2 points in terms of why this is so important. So the Irish government currently gives about 13,000 euros per year as a pension to people. And it's very shocking that only 40% of people in the private sector actually have a pension, either themselves or through their company. And the worrying thing with this is, while your mortgage may be paid at that rate, can you actually have the life that you want to live on 13,000 euros a year? And there's no guarantee that money is going to increase. And we know that the retirement age has increased to 68. And by the time we retire, I believe it'll be over 70 quite comfortably. Who knows, maybe even up to 75. So the question we have to ask ourselves tonight is, could we actually live on 13,000 euros? And this isn't the Friday week, this is just the reality, you know, in terms of where we're at and where we're going. And just give us a factor to consider for later on. And in comparison to that, on the left-hand side, we can see, you know, if you had €6, if you gave somebody €6 today and you got back €10, is that a good deal? You know, so just looking at the alternative from the other point there in terms of if you were to actually invest currently for your future, as I said, based on what your requirements are, what your goals and dreams and ambitions are, it would make a lot more sense for that. So I suppose we'll move on to the next slide. I know we're coming to the last few here. I always talk about procrastination with people, you know, myself, my family members, everybody else, in terms of delaying these things. And we can see that through these 3 examples at different starting ages, based on getting the same return, based on the same monthly contribution, how much of a difference this makes. So people always say to me, oh, Kevin, you know, I'm still young, I'm not going to put money into a pension, or I'm going to do this, that, and the other. That is okay. That is okay. But we need to understand the consequences of actually delaying this. And the consequence is that instead of having 1 million plus, if you started off early, you know, you might be left with only 1/5 of that or 1/10 of that. If that's something that's acceptable to people, that is absolutely fine. I mean, for me, it does not make sense to give up on hundreds of thousands of euros by just starting these things earlier. You're putting the same amount, you're taking the same risk, you're doing the exact same things, and you're working hard enough in your corporate lives or own personal businesses to earn the money you're earning. So why not make that money work for you to give yourself options later on? That's what I'm doing. I have my pension with my employer. I have my target saver with Bank of Ireland. I have my emergency fund through my current account, and I also have my savings accounts. So I'm doing all this short, medium, long-term goals, and I'm trying to get as many people as possible to understand this, to appreciate this, and to give themselves an option later on in life that if they do take this on board and implement some of these plans, they will sleep better at night. That is a guarantee that I can assure. So moving on to the next slide, please. You can see here a common theme that people say in terms of having $1 million or euros in the account. And you might hear things on the media or read things in books, you know, if you start at this age and put this amount in and it grew at this rate, this is how much you would have. For anybody who actually doesn't understand this concept, I would say is until you actually open up an account, put in the money and have the patience and wait it, none of this is ever going to be realized, right? It's just going to stay as a concept or theory in people's minds. And what we're trying to do here is to change that from a theory or concept and place it into as a reality. Thanks so much for everybody for actually participating in this. And I hope that's given us a lot of factors to consider and actually showing us what options are out there. And that, you know, especially with the pandemic now, we might have a bit more time with less commuting to work and, you know, a bit more time to think about these things. And I know myself, certainly, even though I'm qualified in this area, I've actually taken upon myself to actually review my own finances and see where I can improve. And it is a yearly thing you should be doing, you know, just reviewing it, having a chat. It's a relaxed environment. You know, you're dealing with a financial fiduciary and you're dealing with kind of, you know, the most qualified professional people in the industry. This is what we do. This is what we've been doing for the last few years in our career. And it's what we're qualified to do. So I've really enjoyed the chat. Thanks so much for everybody participating and thanks for organizing it. I know we do have more to talk over the next couple of weeks, which we'll be joining you guys with as well. And we hope that we can do one more of these sessions maybe before year end or later on. So I really enjoyed it and thanks very much for everybody. I really do appreciate it.